Today we are discussing an important development in global markets, the growing divergence between softer US inflation data and the Fed Reserve's hawkish policy stance, a situation we are calling the Warsh conundrum. The latest US inflation report surprised markets on the downside. Headline CPI fell by 0.4% month on month, the largest decline since April 2020, while annual inflation slowed to 3.5% from 4.2% previously. More importantly, core CPI remained flat on monthly basis with annual core inflation eased to 2.6% from 2.9%, driven largely by the softer shelter inflation and the easing energy prices. As a result, markets quickly shifted towards the view that US economy may be heading for a softer landing rather than a prolonged inflationary environment. This triggered a strong rally in US Treasury, particularly at the short end of the curve, pushing yields lower and reducing the US dollar interest rate advantage. However, at the same time, Fed Reserve Chair Kevin Warsh maintained a firmly hawkish tone, stating that the Fed has no tolerance for persistently elevated inflation and remained committed to price stability. Despite these comments, markets chose to believe the data rather than the reality. This weighed on the dollar index, although the expectations of another Fed hike have not disappeared entirely, with markets still pricing roughly 50% probability of September rate increase. From technical perspective, the dollar index remained constructive. The previous resistance zone around 100.25 to 100.63 has now turned into a key support area, demonstrating the classic principle of polarity. As long as dollar index hold above this support, the broader bullish structure remains intact, with the next upside target coming in around 102. Thank you for watching.